Live, so I'm assuming we'll be live in a couple of seconds, probably.
I think we're live.
Are we? Okay, let me check. We are. It says upcoming on my end.
Oh, let me go to your channel. I think there's a delay.
Yeah, we're live. Okay, let's get it. Okay, is this thing on? Yes, this thing is on. Welcome everybody. We have Justin O from a couple of cents back based on massive popular demand. Justin has a hard stop and he's moving, so we don't have a lot of his time, but I appreciate you coming on. There's really a lot to talk about today. I don't know, I'll give you a few topics and you choose which way you want to start. We can talk about inflationary concerns. I made a video about that today. We can talk about what's going on with cryptocurrency. Iran actually banning miners, and not that kind of miners, not the small children. The Chinese war on cryptocurrency, the IRS regulation that they're planned, like the whole cryptocurrency issue, tech in general, growth stocks in general, stock market in general, economy. There's so much. I mean, I'll let you pick where to start. Now, I have so much questions.
Yeah, let's start with inflation. So
I was about to say that.
We are at a crossroads. I think it's been a pretty quiet week in the markets because the market is now satiated, or at least really just kind of for now okay with inflationary concerns, because the Fed came out this week and basically said we're still not thinking about tapering now, but they've opened the door to potentially talking about tapering asset purchases in the future. We're seeing pretty scary inflation data out, in terms of like CPI inflation, et cetera. But, I would say we also know that there are a lot of kind of supply shocks, right? So what I would say is the supply shocks, I'm a bit 50-50 on it. And just upfront, I'm a corporate analyst, like finance, right? Valuation guy. So I do, and I'm sure you too, Tom, where I call myself as a macroeconomist by hobby, and I'm interested in it. But where I sit is, I think that this is a recovery and a recession and a supply shock that we've never seen before, right? In 2007, or in the 2008 Great Financial Crisis, I saw some economic reports, some sell-side research reports I read, basically saying that these types of surprises over inflationary numbers that macroeconomists were expecting never happened in 2008. So in 2008, there was actually surprises to the downside. So there was less inflation than macroeconomists were thinking. But you got to kind of, sometimes like economists get in their own little math, in their own theoretical physics, so to speak, right? I think when you really bring it down to what the heck happened, I mean, we're in a global pandemic. People are wearing masks everywhere, which is something that most places outside of some Asian countries never did. We had people like literally shut off and bankrupt or shutter factories for months and months and months. We have people on economic stimulus checks. When by stimulus checks, I would think the stimulus checks weren't as big of a thing, but I would say the state level unemployment checks, where people are now taking like $600 a month in addition. So a lot of the people that do the real work in the economy are making more money in this environment than they did before. So why would they want to go back, right? You're seeing these things where in the US is recovering from this pandemic. I'm fully vaccinated. Half of Americans as of this week are fully vaccinated. So if this whole herd immunity thing is real, we're close. We're close-ish, right? And so people can come back to work. Starbucks are opening, right? Factories are opening. They have come back to work, and nobody wants to go back to work. So, right, I went into a Tesla store actually yesterday in Florida, and because I've been waiting to get a used Model X. I went there and I was like, okay, I want a Model X, please. Can I just buy one, please? And they said, we can't get it to you until Model X's and S's they can't get it to me till January, February 2022. And we all know how Tesla is with timelines. So February 2022 probably means June 2022. And
If anything.
if anything, right? If that Model 3 and Model Y, they can't even, the new ones, they're churning them out. They can't even get them till 3 months later. So you have the highest U.S. household savings in a long time. You have highest personal incomes. You have a relatively unaffected middle class. You have a very affected kind of service economy that's starting to come back. But you also have economic government support over and above what people used to make until September. They're still on this thing. They're still on the government like unemployment like additional payments. And so all this just munges up into the fact that people want to buy things because they can't go out and drink and party and eat, right? Services, or they can't go to Disneyland or whatever. Like even if you can't go to cruise lines. So services are muted. Like you can't really do the things that you wanted to do. People have a lot of money. They saved a lot of money. They just want to go crazy. So what are they doing? They're buying things. And guess what? Buying things and goods are also the things that rely or have relied on global commerce, global trade, and global production and U.S. production. And guess what? Production got hurt because the service people don't, or like people that are working those jobs aren't coming back. And the trade's been muted because nobody wants to spread the pandemic. We're not getting anything from India, I guarantee you, right? Because our fear of the India variant is way higher than trying to get cheap Indian manufactured goods. So all that to say is, I think that we will see inflation, and we are in an inflationary environment. I do not believe, like, I find it hard to believe that we will be. I want to say I find it hard to believe that we're not going to fall into hyperinflation. But then
there's no chance. There's no chance of hyperinflation.
You don't think so?
No chance.
Okay,
0%.
Can you explain your position there?
First of all, I was surprised to hear you quote pretty much Kathy Wood unintentionally, probably.
Yeah, I've been moving around. I haven't even heard her last week. So you literally voiced her thesis, which I find kind of amusing because you disagree with her so much. And she essentially said the same shit. She was like, people are going to go outside. They're going to buy less shit on Amazon. They're going to consume more services. It's going to be a deflationary impact on the market, which is going to. So I don't actually fully agree on that, right? So I think
I don't agree. Okay.
So I don't agree.
Answer this, and then I'll tell you why a hyperinflation is 0%. It's not possible. But explain yourself first.
Yeah. So I didn't necessarily mean. I'm saying what we're seeing now. Like currently, the data points we're seeing, I'm explaining it, is people aren't going back to. There's no Disneyland to go back to, right? There are, and they're planning to reopen soon, but a lot of that money is trying to buy goods. So what you're seeing actually is like the PPI and the CPI spiking because people are buying goods. People want to buy cars. Guess what? Ford can't make enough cars. It's Ford, right? It's Ford. It's not like, right? There is a car shortage and a home shortage in America right now for a multitude of reasons. Homes have their own thing going, and we can talk about that probably next time. But people want to buy big ticket goods.
People
one of the calls that we made
because of inflation, I think.
No, I mean, if you actually, like, I think inflation is a overarching macroeconomic driver. But if you ask like your average home buyer in America, why are you buying the home? Like, they're not going to say, oh, because I'm really afraid of hyperinflation.
You don't think that investment-based real estate acquisitions, like residentials, impact this market? I think it's massive.
No, I do.
What's the first thing they tell you to buy when you have inflation?
But you have to bifurcate institutional buying from single-family home, like a primary residence buying.
You know how many individuals I spoke to this month that are buying real estate because they think it's better than gold as a hedge? They're taking money out of the stock.
Well, yeah, I mean, even if they are, I think that's an oversimplification, right? Because people are, a lot of times they're buying more value in their the walls than the actual land.
Well, okay, so.
Well, anyway, that's a whole other thing, right? We're going to dive into real estate analysis.
So you're saying basically you're saying that you don't agree with her. Basically, her thesis was once shit reopens, well, then everybody will be consuming far less goods, much more services, and reopening is going to eliminate a lot of this over
I'm in the
demand.
economic camp that when we reopen, there's enough savings and personal income now that consumers will consume a net more of both services and goods.
Okay,
And
so
I don't think there's going to be an outflux from online spending. There might be a downtick and a normalization, but I don't think it's coming back down to pre-pandemic levels. Like you have to think about it. Like once things reopen, it's going to be a 1 to 2 year grind, right? I know a lot, like I go outside right now, like people, like stores are usually like masks on. I'd say 80% of people are still masks on, right? So it's going to be like, okay, now Starbucks are open. So now people can go, oh, like, and then it takes a while to get into the, like the psyche. And so I think you're going to see these things kind of more gradually than I think we think. Like, it's like, I think we think about things in a macroeconomic, like, equation, like when X happens, then Y and Z. But in reality, right, it's more of a grind. And I'm hoping that as we reopen during a grind, like if what Kathy is saying is true, where goods purchases let up a bit because people are going to spend on services, then that'll give the goods sector more breathing room to go rebuild the whole supply chain. But my thing is, I don't think it's like this thing happening, right? I think it's like,
well, she has a. I like her more than you, and I don't subscribe to the. Kathy would. Same people who were claiming she's a genius like 4 months ago. Now she's saying she's an idiot. I mean, I think I give her respect from day one, and still. So she has a very interesting theory. I don't agree with everything she said, but essentially she was saying, well, there's two things going to happen. One is what we just talked about. The other one is going to be deflationary impacts on the innovation, cannibalizing old school service providers and good manufacturers, which is kind of makes sense, but it's more of a long-term process. It doesn't happen overnight. But here's the thing. If you agree with Kathy or don't, my position is very clear. So I made a video today, which of course you watched because you watch all my videos. And
I've been traveling. I've been moving around, so I missed that one. Well, yeah, what's your position again?
I'm in a tunnel. So in my video, I said there's literally 0% chance of hyperinflation. It's FUD. Reason being, by the way, between you and me, there's only one person here who lived through hyperinflation. That's me. So I was a kid in 1992. I was an 11-year-old kid in Russia. So I lived through actual hyperinflation. Trust me, you have no idea what real hyperinflation is. Like in real hyperinflation, what you're talking about is when you get paid, and then 2 weeks later on your next paycheck, you can't afford fucking lemons because now they cost more than your paycheck. And your entire IRA account is bullshit, zero. Your savings are worthless. You have to. It's really not a pretty sight.
Yeah, and I would say. So what I was actually going to say.
Wait.
So I'm not disagreeing with you here.
So let me give you some numbers. So you know the definition of hyper, right?
No. Why don't you educate me the actual definition of hyper?
So there's no like official, but like the guys the consensus is that if you want to talk about hyperinflation, the threshold is 50% per month.
Okay, yeah, I don't think that's happening.
So in Russia, we had 2,500% per month when this happened.
Yeah, that's insane.
Okay, so that's not happening. So the whole, like, I hear people on YouTube like parroting each other, like, let's get some clicks, hyperinflation.
Well, yeah, I mean, you like, right? It's the title of this video as well, right?
Yes,
so
yes.
I'm saying I was just speaking towards, are we going to see runaway inflation relative to what Americans are used to? So when I say hyperinflation, when I see that on YouTube, right, I'm meaning it more towards 1970 style inflation.
Hold on. Okay. So now again, we're cousins, but we're not brothers. I'll explain to you what I mean. So in the 70s and 80s, the highest inflation US ever had was 15% per month. Was in the 80s. I think pre-Reagan. I'm not sure exactly when that happened, but like they were coming off the 1970s stagflation, and they were had 15%, like that, and that is very high. That is insanely high.
Yeah.
I don't think we're headed there either. However, when I hear Jerome Powell talk about this is transitory, you're a fucking muppet. That's what I'm thinking. I was like, what are you talking about? Even now, you're at 4.5%. So he's saying, so you have an official, a government official sitting on live TV and on national TV saying, well, it doesn't matter that we printed $1 gazillion of money.
Do you believe
It
in
doesn't matter that
4.2? The 4.2 that came out, 4.2 to 8. What was it? It's year over
yeah,
year too. That's annual,
yeah.
right? So
Well, he's saying that it's the comparable is April 2020. So the comparable is the worst month, the pandemic first, the first real month of the pandemic. So he's saying that it's skewed, which makes some sense. But hey, hold on a second. So he's not an economist. I think
yeah, he's
he's
like a
not.
banker. He's a
Yeah,
banker.
he's a banker. So he's saying,
Comes from my world.
yeah, well, all you bankers are pieces of shit. We know that. So, anyways, so I used to work for a bank, so you know this, and so I include
Me as
myself in that
well.
definition. Yeah. So okay, so let me tell you a story. When I used to, I won't name the bank or the people, but let me just explain how insane the people I used to work with. The CFO was a shorter gentleman. Let's call him Doug, for the example. And we went home one night, came back next morning. We found out that one of the urinals in the night, he had people over, professionals, to lower the urinal and put in his name tag, the CFO's name tag, on the lowered urinal. That was the type of humor they used to run on each other. Like imagine spending money on that and energy. I mean, bankers are pretty much, it's like football players and criminals, bankers. That's my ranking
Okay, that
of
makes sense.
society.
Um,
So
yeah, I guess
then
moving
serious
on from that, I think
jokes
one.
aside. Okay.
Okay,
So let me tell you
no, go ahead.
something. Jokes aside. So tell me if you agree with me. So my sentiment is, if you're printing endless money, if you're giving out endless money, essentially you're printing, you're giving stimulus, and including this the infrastructure stimulus, not just the checks that people are getting. So you're throwing all
5 trillion,
this money.
right, as of today.
Yeah, you're buying junk bonds, so you're pumping money into the system endlessly. And I get why you're doing this, but you can't have the cake and eat it too, or you can't, whatever the order is. I mean, you can't sit there and say, well, we have 0% interest, which means nobody's saving, and we're pumping money, which means that we're basically throwing everything we got at this fire to try to keep it as high as possible, and it's not going to impact real inflation. I think we're headed anywhere probably to the 6 to 10% area, not the 70s, 80s. But mind you, the 6 to 10% is going to be very painful. It's going to be very painful because mainly what it does is not necessarily make your Big Mac expensive. What it basically will do to 6 to 10% is have really adverse effects on on the technological sector in the stock market, which will cause a massive impact to the entire economy. It's going to be a trickle down effect. So once that happens, you'll see that every tech stock pretty much take a massive hit, which will lose a lot of money for a lot of people. Which will, you have this whole cycle of bullshit starting from that point on. So for me, my fear is actually Jerome Powell. Actually, I think he's asleep at the wheel, and at some point he's going to wake up and say, "Oh shit!" And then they're going to increase interest rates so high they're going to fuck up the economy and put us into a recession. That's my fear, not specifically the inflation itself. I think if he was more aware right now of what's going on and be more pragmatic and not trying to basically say, "Oh, we're not raising interest rates. No, we're not going to." I think that's my concern, because I think he's going to wake up too late and going to try to pump the brakes going 90 on the freeway, which is a dangerous thing if you get my analogy. But
Yeah. So just to solidify what I mean, like I said, as a hobbyist, it's hard for me to take a huge view on what inflation is going to be, right? And I agree about the whole banking industry, but also those people are those companies are the ones that hire economists, more economists than anybody else does. So they produce research made by people too. So, and again, I left that industry for a reason, so I totally get you. The counter argument towards inflation is that we haven't seen runaway inflation without bank lending. So bank lending is still relatively muted. So that's just one thing I want to throw out there into the ether. because basically the whole bank lending thing, it's the money multiplier effect, right? So when banks need to lend out more money in order for that to like really multiply the effects. And I had another one. Oh yeah, and then so the 5-year break-even inflation rate right now is what, like 2.6% as of right now. I'm looking at it from Fred data, which is something we had in 2000 to 2004 to 2007. Like that's about that expectation, somewhere in that like 2.5%, which is something that in terms of Jerome Powell sleeping at the wheel, what I think, and what, you know, I go back and forth, right?
You can't talk like me. You can't say the same shit I say. You have to be way more careful. I can say whatever the fuck I want. You have to be.
You can't. Yeah. Well, no, but and it's not really my view though. Like I'm someone who sees through the prism of many different angles. So I would say, I think we will see inflation worse than what the Fed thinks. I agree with you. I mean, I think it's kind of a straw man, but it's like, I agree with you. We're not going to see 50% month over month. Like we don't even need to talk about that, right? Because we are the world, the difference between us and like even anybody else, we are the world's reserve currency, right? So
definitely.
So that bails us out in and of itself mechanically. We can bail ourselves out because we can print the money in which we pay for our own debt. Like that's
unlike Russia or Zimbabwe or any other.
Yeah, unlike the fall of the USSR or whatever, right? Like those were
Hungary,
never.
Yeah, Hungary, Zimbabwe,
right? Or Argentina now, right? Like or whatever, right? So we're just different. And the only now is there a non-zero chance the world blows up at any given point, right? This pandemic was a 4 standard deviations, whatever, by prediction, but like things can happen. And the only thing that could happen is the US loses its reserve currency status. Now, do I think that happens? Base case is no, but is there a 0.0001% chance it does? And it loses to some amalgamation of the digital euro and the digital yuan and Bitcoin, then maybe. So the one thing I will say, and I agree with you, I agree we're cousins. I haven't arrived intellectually to the points that you have because, you know, I think it's just hard for, I don't feel in my element here, like deep enough to really say like with conviction what I think the interest rate that I think the 5-year average inflation rate is going to be more or less than what the market is saying at 2.6%. I don't really have that view. I think if anything, I think a little bit higher, but not runaway. What I think I am fearing, if you pull up the chart on just Fed funds rate over time, is anytime we've been in a inflationary environment, it's been an absolute headwind against all assets across the board, right? And so traditionally, before Bitcoin's presence, gold was the only thing that really you could hide out in, right? Because if inflation's rising, your cash is getting devalued. But also, your required equity return is going up, therefore your prices are going down on equities. And and much more, so much more on the much more on growth stocks versus value stocks. Secondly, real estate suffers because for every 25% higher, whatever, there's something where the higher the mortgage rates are, people can afford 50, 100 grand less on price, right? It's like, it cuts the other way, like horribly. So real estate gets really pressured. So, and also like bonds suck, right? Because if your yields your real yields are going up, then your principals your quoted bond rate is going down. So where do you hide? You can't do cash, you can't do bonds, you can't do stocks, you can't do what did I say? Real estate's tougher, and the gold is acting weird. Gold's been acting weird for 3 years, and it's finally recovering to all-time highs, but it tanked there with other things, right? It's kind of crazy. So what I think is actually we're in this weird. There's a lot, obviously, infinite amounts of factors. I think Bitcoin is taking market share from gold, but it's on its own volatile. What do you call it? Network adoption curve. So you can't really see it in Bitcoin's price movements, but on the margin, millennials like me, I'm actually using Bitcoin and I own zero gold. Even though I'm someone who conceptually would want a gold allocation, I'm actually using more of that to Bitcoin. And it's something that I've believed in since I bought my first Bitcoin at $300, right? So there's that thing. Bitcoin, I think, is a 10-year place to hide out, or maybe gold. I'm not really sure. Gold, I haven't really followed gold, but gold has been acting weird. Secondly, I think real estate probably is a good place to perform, but you got to be really, really careful because, right, if we have interest rates going up, real estate really gets pressured too. So people need to realize that. I understand the land value. So there's two. I'm talking about specifically single family real estate, single family. So if you buy your own home, like as a person, there's the land value and the improvement value, right? Most people in America, at least where I'm familiar with, are buying more improvement value than they are land value. I agree the land value is an inflation hedge, but like, I mean, the lumber in your walls is not an inflation hedge, right? It's, I mean, at a certain point, there's replacement value stuff that you can do, et cetera.
Well, difference.
And then the last thing is,
depends which state. Certain states, the real estate is, I mean, depends where you're buying the real estate.
Yeah.
Some places that the land value is kind of fucking high.
Yeah. So, and you can't even replace it. So here in Florida, that's the same way. I grew up in California. You can't build new because the land value is so high. I'm just saying, on average across the United States, if we're thinking like macroeconomists. Last thing I'll say, because I know we've been kind of going through these loops, but the conclusion, if I'm going to make a real big stance, is if we see this chart you pulled up go on the uptrend for a multi-decade period again, if that's what we think, we have to look back at a really tough time in investing back from the 1950s to the 1980s. And who came up, what style came up then that outperformed everybody else? Warren Buffett. So we're back. And what style has, at least under the narrative, underperformed over the last 2 decades?
You know what's funny?
Right? The value, let's generate cash flow today, tomorrow, the next day, buying yield in companies that are really solid, have moats, and will generate free cash flow growth into the future. So I'm not saying that's where I'm all in. Like I manage a portfolio, right, at a couple cents.com, et cetera. And we're growth oriented investors there, right? So we're some mixture of the two. And there's secular trends you can always find elsewhere, right? But then again, now you have Cathie Wood saying that we're in this golden age of innovation. So there's so many factors, honestly. Like I'm going to pick the stocks that I know is going to grow EPS, grow EBITDA meaningfully over a period of time, run it through a DCF, be extra conservative on both projections and discount rates. And the ones that spit out really good outcomes, that's the one I'm going to buy.
I can't believe you have to get off in 6 minutes. There's like literally like 15.
Here, let me send a text if I can.
I have like 15 follow-ups up to this. First of all, I'm going to rename your name in the chat to Michael Burry. You just pretty much quoted his mantra right now. I mean, did you see this 13 Fs?
I've been out of the loop for like 3 weeks, by the way.
You want to guess which 2 companies he bought calls on? Facebook and Google.
Yeah, we own Facebook on the big board. It's trading right. Google's trading at like 15 times forward EBITDA for a GOAT type of company. The only thing that people are forgetting about is if the government cracks down on their Facebook deal, they lose half of their internet traffic, and they live and eat and die on their internet traffic. That's their only thing. Yeah. Facebook has 20% growth rate. It's trading at 13 times EBITDA. Like that's a no-brainer.
Yeah. And you know what? He also shorted the 20-year bond.
Shorted the bond or shorted the yield?
Yeah. Shorted the bond. So he's essentially saying what you're saying as far as what's coming next, as far as inflation, and which companies is he buying is exactly what you just said. Funny enough, I just had a conversation, and until you tell me otherwise, I assume a 3 p.m. hard stop. So I just had a conversation with the guy literally before I got on this thing, and it's like, okay, Tom, what should I get to hedge myself? Because literally everything is too expensive. The whole conversation we just had, it's like I can't pay real estate. I said, dude, just buy some Berkshire Hathaways. I mean, that's they're cheap versus
not a bad idea.
And it's like it's 400. I said, just buy Class B. It's like $300. It's the same stock. So I was literally just telling the guy that's a really good hedge. You probably want to. I mean, you can do it yourself, but why would you? Coca-Cola, Dairy Queen, some oil, some gas, no crypto. It's like the opposite of what we do. That's the perfect hedge for inflation. And he definitely outperformed during inflation. But hey, here's a question. It's super chat, and it's like right up your alley, the whole DCF. And it's like you.
Why does future inflation expectation hurt growth stocks, doesn't inflation also mean higher prices and hence higher revenues and higher profit? So it means that higher inflation increases your expectations on return, right? So when inflation's higher, you need more return as an investor to beat inflation. So if inflation's zero, you're just like, I just want a return, right? To beat 0% inflation. If inflation's like 2%, you're like, oh, I need 4% to beat inflation. If you need 5%, it's 10% or 8%, right? So when that grows up, right, your expected and required return as an equity investor goes up. So I did this a long time ago, maybe in December when we first started talking about inflation on my channel, where I did a little DCF comparison of a value stock, free cash flow, straight lined or growing very slowly over 10 years, and one that is 0, 0, 0, 0, 0, 50, 100, 200, like a Tesla or something like that, where when you discount cash flows out into the future, compound interest does this, right? But when when like you think about it going backwards of what this cash flow is worth today, it cuts exponentially the other way. So $100 in 10 years is like nothing, right? $100 tomorrow is something, right? And $100 tomorrow is way more than $100 in 10 years. And that differential changes based on expectations of interest rates into the future, because the higher return, the steeper this compound interest calculation gets. But the lower the interest rate is, the flatter the compound interest rate gets. So that means that cash flows out here don't lose as much value as they would if your expected return was higher. I'm kind of butchering this whole thing and going in circles, but I would just invite you to learn a little bit about the DCF, where it's a simplistic way to think about it. I think Warren Buffett or Charlie Munger had said at one point that if you were buying a $50 billion company and wanted a 10% return, and that company didn't pay you this year, but would start paying you next year, that company would need to start paying you and they would pay you an annuity into the future. That number would not be 50. It would go to 55 next year if you didn't get it now, or 60 the following year. So yeah. So really it's like cash today is worth more than cash tomorrow. That's the reason.
So I'm going to pull up something on the screen just to give people an example, a technical example of what you just said, which is brilliant, really good explanation. So from a technical standpoint, this is an example of a very, very simplified, ultra simplified DCF. And just to show you what Justin is talking about, if you look below, you can see the DCF value of this company is $150 billion, 149. If the only thing I change is I raise the discount rate to 12% across the board for the entire 5-year span, it goes to 110 billion. We just lost $40 billion in valuation over a 2% discount increase.
And that's a growth stock, yeah?
Yeah.
Yeah. Versus if it was a value stock, the percentage loss
for value
on
stock,
value, it does go down, but much less. Yeah.
Well, the principle is the further your best years are, the more you're impacted by higher discount rates, because they discount the future much more intensely than the present value.
I can go 10 more.
Yeah. Oh, let's do it. Nice. Okay. So finally, so I hope we answered your question, Vikrant. We sorry it took so long to pull up your super chat. Thank you so much. So here's we'll kick off with this comment. Just follow MicroStrategy and go to sleep. So segueing from this comment to my next question. You are my cryptocurrency expert, the reigning cryptocurrency expert. As somebody who legitimately lived through the nuclear winter of 2017, 2018, and so forth, you've been there, you've seen there. You're like the guy from Fight Club. You know, the guy says, you don't know where I've been. So you've seen it all.
Seriously, yeah. For those of you new to the channel or new to me, I was down hundreds of thousands of dollars, right?
And you didn't sell, obviously.
No, I didn't sell.
So first of all, if you could share just a little bit of the nuclear winter story, and also what's next for crypto? As far as, I mean, you're the biggest crypto expert I know, so I would be curious to hear.
Yeah, I would say I'm a crypto enthusiast. I'm going to the Bitcoin conference next week. And I'm going to be asking really hardcore people, right? Like, I think people tend to be tribal. I just like to find the best investments out there. I mean, if it looks like a zebra or a giraffe, I'll just whatever. This one looks like a zebra, so I'm just gonna, it looks good. Bitcoin to me is a bet on an internet monetary network, right? We will have an internet money, maybe not. Do you think we'll have internet money? And do you think that there's a place in the world for a non-government controlled internet money or internet store of value, internet asset, something where we can transfer some semblance of wealth to each other, right? And it's like a Picasso or a Monet is a store of value as well. And so my thesis back, like I bought my first Bitcoin at 300. I bought a lot at 8,000, 9,000, 10,000, all the way up to 17 to 18,000. And boom, went down to, you know, at the bottom was like 3,000, right? So think about how bad I felt, right? And then I just didn't sell it because some of these things, I said this on my live stream last night. If you want assurance on returns every month, every quarter, every year, go buy a bond, go buy a dividend stock, right? If you want a 2-bagger, you're gonna have to deal with some volatility. If you want a 5-bagger, you're gonna have to take some big, you're gonna have to go a little bit, you're gonna take more on faith. You have to believe more that more happens, right? The people that bought Tesla way back when and made a ton of money had to believe that this fledgling, almost bankrupt company could get its first car out first production car out the door. That's big. You know, you had to believe a lot more than you have to believe now. The people that believed Bitcoin back then when I was buying, you have to believe, I mean, we're still here. We're still early. The question here is, right, as analysts, we are probability weighted distribution allocators. We say there's a 10% chance this is going to happen, 20% chance this is going to happen, whatever. And what are the outcomes? And you probability weight the outcomes and you get a present value, right? So what I did was like, okay, so there's gold, which was the first like store of value medium of exchange thing that we had as humans because of a lot of different reasons that I can go into. And then you had Bitcoin, and that's like the physical medium, and we have a physical world. Now we are 20 years into building a digital world. Do you think the digital world also will have a native store of value, native currency, et cetera? If you think that, maybe you don't think that, right? But that doesn't mean you're wrong or you're right. We're probability weighting stuff here, right? So I say 50-50. Let's just say it's 50-50. And if you say that the internet is worth more than e-commerce is going to be worth as much or more than physical commerce, I think that's already, very few people would argue with that, right? Like internet is worth equal amounts of money as the physical trade, right? And so if you believe that there will be internet gold or money or store value or medium of exchange or reserve currency, then you also will believe that whatever that thing is, there's only one, right? Money networks are really, really winner take all or winner take most. There's one reserve currency, it's the US dollar. So there's going to be one internet reserve currency. I think it's Bitcoin, but it might not be Bitcoin. I might be wrong. And if it is Bitcoin and that does happen, and that's going to be worth as much as gold, then that's $500,000 per Bitcoin, right? And if it doesn't happen, Bitcoin goes to either zero or Dogecoin levels where it's just kind of like fun and people just hang on, right? There's some value to it, but it's not going to be whatever. So probability weight, the 50-50, your target price is at least $250,000, right? So from here, like that's what I did. And that's what gave me the confidence of buying at the top and not selling. Like I'm a very rare person where I said, I bought at 18,000. I saw it at 3,000. I didn't even keep up with it, right? You just, is the probability weighted price target worth your upside downside right now, right? So right now I say my probability weight is have 50% chance it goes. So 300,000 target price. So that's, you know, a 10x, 10-bagger, and your downside is you lose all your money. So I'll take that bet all day long in the casino. And so if you had enough money, I mean, casinos legitimately take worse odds than that every single day, every single transaction. So if you agree with the logic, then that's the bet, right? Not to say go all in on it. Not to even say go as much in as Justin did 5 years ago, right? But that's the thesis. And I'm not going to call is this the bottom, is that we're going to go through a crypto winter. Look, I would just say, don't worry about the price action. Worry about the finish line.
You have some of your own fans here, by the way.
Oh, thanks, Danica. Appreciate
it. Somebody said earlier, I had this on the screen. So hard to explain this in my own words. Very well said. I agree. Justin, looking at this chart for the 3 minutes you have, I think if you just look at this chart on the zoom out pattern of a 5-year pattern, if I wouldn't tell you it's Bitcoin, you would have said, well, that's just a natural correction. It went parabolic and now it's correcting back, right? It doesn't seem odd if you look at the 5-year chart.
Oh, yeah. And so you can even plot it on a log scale and it makes a lot more sense. Because what you're actually betting on here is people are now like, I'm through 2 crypto winters, right? I bought at 300, it went to 1200, crashed back down and was there for like years. And then went more all in the last cycle, obviously. And so if you zoom out, you put it in the logarithmic chart. If you go to CoinMarketCap, it's pretty easy. You just go to CoinMarketCap and you put log chart. It makes a lot more sense because what you're actually investing in is exponential growth of a network and network effects of money. These prices don't mean much, right? So because this is like on an arithmetic scale or geometric scale.
So I want to ask you a question.
But I agree. All I have to say is I completely agree with you. Zoom out. It's like, it doesn't really seem odd.
Somebody taught me that when in doubt, zoom out.
Yeah.
So 2 minutes left. A lot of your fans are all over the place. There's a few of them here.
I told them to come join and follow.
Oh, that's why we have almost 1,000 people. All of a sudden, we had the big spike. So it was you. Nice. Thank you so much for doing that. By the way, you always pull good numbers. Last time you were here, you did like 1,000 easy, 1,000 concurrent most of the stream on the boring topic like inflation and crypto. I mean, you make it interesting. So before you leave, quick question. I know you're a huge Bitcoin fan, and you have this whole theory about the spectrum of the further you go from Bitcoin. What about this newfound? People are really religious about Cardano and Ethereum, like any of those. And of course, I'm not. It's not a prediction question, but rather, do you see this as a game of a binary, one winner, everybody loses, or some sort of a shared market where there's a few currencies that actually coexist?
I used to think that it was winner take all. I'm starting to think that there's a possibility that it's oligolopic, if that's an adjective. And I used to think that these protocols would act more like TCP/IP, which is how they've been characterized. But I also see how the internet's evolved to, like, people are on AWS, which took #1 market share, but #2, #3, #4 are still strong. Google Cloud strong, Microsoft Cloud's strong. They just won the Jedi contract, right? Maybe it's more like cloud services, and maybe it's not like TCP/IP, right? So I don't get the tribalism. Crypto has always been really tribal because crypto, I don't know. Like, I don't get into the tribal. I also don't get in the tribal of GameStop or Tesla. Like, the Tesla people were so tribal against, like, they would never even consider investing in Ford, right? But Ford is outperformed.
Did you get some heat for selling at the 900 or 800 when you sold at the top? Did you get some flack on that?
No, because I would say everybody on the stream follows Tom and Justin for a reason, because there are the people who are like more skeptical and like more careful, right? I think the people that buy in on the extremes, I mean, that goes into like anything, politics, right? The people that buy in on extremes are just people that become really tribal. But crypto, because there's a lot of money on the line and the price point's so low, and people that consider themselves crypto people, they have this whole thing going. They fight. But to me, this is like people saying, I'm invested in MoneyLion, screw SoFi. I hate SoFi. I'm going to do everything online to screw SoFi. And then the people on SoFi do saying the same thing with MoneyLion. That's kind of maybe an esoteric reference, but maybe we go, what's like a fledgling startup. basically, once you go outside of Bitcoin or outside of just pure cryptocurrency, so Bitcoin, Litecoin, whatever, Bitcoin Cash, it's all it's accessible liquid venture capital, and you're investing in the success of the venture capital of the network as it pertains to solving a real world problem. So Ethereum has all the dApps being built on it, but has a scalability and throughput problem. So we have yet to see if the team can actually finally deliver Ethereum 2.0 and proof of stake, which is something that they've been talking about since I invested back in 2017, 16, 17, something like that, right? I bought my first Ethereum at like 200, 250. And so I bought Ethereum. I don't hate Cardano. Maybe it's like AWS and Microsoft Cloud. But
that's a good comparison.
These people think, I think, like, if for Cardano to succeed, Ethereum must also fail. And look, do they know when proof of stake's getting rolled out? I sure as hell don't. So if you believe, like, in order for any of these things to do well, you need to believe a lot more things. You need to believe crypto does well. You need Bitcoin does well. You need to believe that Internet 3.0 and distributed dApps and distributed smart contracts are a thing. And even if all that happens, what's the intra industry dynamics? Is it winner take all? Is it oligopolistic? Is it an oligopoly? I can't speak today. Is it an oligopoly? Or is it a monopoly, right? Like
I'm Russian.
TCP/IP.
We know what oligopoly is in Russia. Listen, it's 3 minutes past your extended hard stop. I don't want to be hogging your time. Somebody says oligarchy. Yes, that's
oligarchy. That's it.
Yeah, that's the one we're looking for.
Hey, Justin, numbers, no English too good.
I'm gonna have you back hopefully as soon as possible, as soon as you move to the new location. And it's been a pleasure, like always. Shout out to the 900 people in the chat listening to this very interesting discussion. I mean, I really enjoy your take both on crypto and inflation. It's always a pleasure having you on here. I'm gonna let you go since I know you're stressed for time today.
Yeah, and thank you for having me on. I love it. I'm just like mid-moving here from Tennessee to Florida. So starting in 2 weeks, I'm here for you, Tom. I have a lot more time to come on whenever you want.
Let's do it. And I'm going to put it out there that we may or may not do something together. So I'm just going to put a little pin in that. Thank you so much for everybody for stopping by. Justin, thank you so much. And we'll see you guys shortly. And Justin, good luck with the move. Hope it goes smooth. And thank you so much.